Everybody is talking about and worried about, and many are predicting a big real estate crash. I don't see it. And I might be eating my hat, okay? I think there will be some continued softening. I think people have got to dissect that discussion between linear, cyclical, and hybrid markets. When you segment by price, by geography, and all of that stuff, I think the necessity level housing is going to fare pretty well through this. And remember, at the end of the day, it's always the question of compared to what. It's not just the question about what is real estate going to do, but the question is, if you're an investor, what other option do you have for your money, right? There's an acronym in the investing world, TINA, T-I-N-A, and it stands for there is no alternative. And so when you look at investing, you always have an opportunity cost. If you close one door, you open another. If you open one, you close another. And that's the decision investors always have to make. What is the highest and best use for my money? Where can I get the return? If you look at properties that are pretty conservatively performed right now with vacancy rates, repair costs, maintenance costs, management fees, overall, because income property is a multidimensional asset and you're not just earning your return one or two ways, they'll perform with leverage, of course, over 20% annually. In a country as large and diverse as the United States, there's no such thing as a national housing market, okay? There are really just local markets. And the old saying in real estate that we've all heard is all real estate is local, right? And that is true. And so we have almost 400 what's called MSAs, Metropolitan Statistical Areas. We have over 3,100 counties in the U.S. We have over 9,000 cities in the U.S. All of these markets act somewhat differently. Of course, they're related for sure. And I divide them into three basic types. The linear markets, these are these boring markets that are inexpensive. They're characterized by always low land value and high improvement value. People have to remember when they buy a property, they're really buying two things. They're buying the land and they're buying the improvement sitting on the land, the house or the apartment complex, right? Or whatever office building, doesn't matter. And so when you have low land value, that's where the froth is. And so when things are going up and the market is going crazy, land values skyrocket, usually buoyed by high affordability and low interest rates, right? And good incomes in comparison. But when they're going down, land values do soften. They do soften a lot. The improvement value doesn't soften that much. Of course, in a down market and during the Great Recession or the global financial crisis, whatever you want to call it, we did see a lot of deals that were below the cost of construction. But the construction materials, and you both know this all too well with your business, they are commodities traded globally, not attached to any one currency, and needed by every human on earth because everybody needs food, clothing, and shelter. And so these materials set something of a floor on values and how much they can drop. So what I say is buy in these linear markets where land is cheap and improvement cost as a ratio is high. It's a bigger part of the equation. So a cyclical market, on the other hand, is the complete opposite, right? That's like where I grew up in Los Angeles, California, okay? In a cyclical market, you have really high land values and as a ratio, low improvement cost to land. And when things are going up, it goes up like crazy. And when things are going down, it plummets fast. I mean, look, real estate is a credit-based asset class.
Yeah.
So when the cost of debt goes up, the deal looks different, no question about it. It's more susceptible in those cyclical markets, and hybrid is the third kind, just in between the two. If you look around the world, most of the world is a linear market, like the middle of the country. And the coast are the cyclical markets. Those are the markets that get all the attention in the news media, are the cyclical markets because they're newsworthy. There's something going on. They're going up, they're going down. The boring linear markets don't get that much attention. This chart, I have long said on my podcast and YouTube, I've been talking about how about 25% of the mortgages in the country, the existing mortgages out there, right? There's about 100 and, I don't know, depends who you ask, but there's around 140 million housing units that are owned, right? And about 25% of those have mortgages below 3%. I mean, think about that. Why would you ever want to give that up.
Right.
People will beg, borrow, and steal to protect that mortgage asset. And here's the funny thing. You can have something that is worth more to you than it is to someone else. This is a really important concept that is hard for people to get their head around sometimes. And so that house with that cheap mortgage may be more valuable to the person already owning it than it is to the market that sets a new price on it. That's the poison pill the Fed, the dysfunctional central planners that run our economy, have put into the market. And guess what? That poison pill has a 28-year timeline left on it. And that will constrict housing inventory for decades to come. Because I don't know that we'll ever see these kind of low rates, but people have 28 years left on those mortgages at 3%.